Is self-managing your 401k a good idea? I've recently had a call with a financial advisor and he looked over my investment profile and provided some feedback. The advisor pointed out my 401k was heavy in redundant assets and was biased towards a target date fund that historically doesn't perform as well as some other investments might. My question is, do most of you self-manage your own 401k, and if you do, are you more cautious or diversified with that versus non-retirement specific investments? Yes, it's a good idea. It doesn't take any effort to put your money into one or two index funds. That's all you need. My company offers a low-cost target date fund with an allocation that makes sense for me. I've always used it and don't have regrets. Self-manage. I am 30 and have 95 in a total market index and 5 in a total bond index, and will start allocating more towards bonds as I get older. Don't need to get fancy. Set and forget. JMO, and granted you didn't provide any info on where you are in your career cycle. Any good 401k should have a very basic tool to suggest a reasonable mix of mutual funds for your specific goals, age, risk tolerance. Just, largely, match what it suggests and rebalance it once a year and leave it alone. Your job during your working years is to work. Focus on your career, keep contributing as much as you can. In the long run, the market will ultimately take care of itself. If you talked with a financial advisor and your first thought was I should go get a second opinion from anonymous people on the internet, I probably wouldn't listen to them. Financial advisors need to prove why they are qualified. Whether or not you are a good custodian is irrelevant. He needs to prove that he is worth the cost to have a managed portfolio. Wealthy people pay financial managers because they have different wealth priorities, and the scope of their investments require more attention than one person can usually afford. Tax loss harvesting alone will often pay for the entire cost of a managing professional once you have a certain amount of wealth. And, if you had a different allocation, he would have told you why that is wrong also. I'll tell you this, no one cares about your money more than you do. I don't trust other people with my money. Those other investments are likely just similar things he wants to sell you to get a commission on. I self-manage my 401k. Most is in the SP fund that is offered in my 401k. I have a bit in a small cap fund as well. I self-manage everything. My retirement savings is mostly Vanguard Admiral funds, primarily those comprised of US stocks. Few in my experience target date funds tend to have high expense ratios and have too high of a bond allocation for anyone under 40. So your advisor is probably right on that point. But unless he can provide a compelling reason as to why he can outperform basic indexing like the SP 500, there is little reason not to manage things yourself for now. A financial advisor is someone who takes one of your net worth every year, as payment for doing something you could learn to do yourself after a few hours of research. Yes, do not let anyone convince you otherwise. Financial advisors will take and that adds up over 40 years. FA are dead professions and will not exist in 10 years. Without knowing the plan, the simple advice for 401k plans is that 100 SP 500 is usually a safe answer. Sometimes there are low-cost target date funds. Not knowing the plan, SP 500 is almost always the lowest fee equity fund. There is really no reason to diversify beyond equities until you go, holy crap, I've got a lot of money here I need to protect. I have 2 retirement accounts. One professionally managed and one self. The self-managed account is doing way better than the other. I work in tech and have a heavy business consulting background, so in my self-portfolio I only invest in tech companies I would like to work with. This mix works for me. A 3-fund portfolio is easy to manage. If you feel you need an advisor, make certain you contract with someone who had a fiduciary responsibility to you. Anyone else is just a salesperson. Bias towards target funds? Sounds like they are itching for fees. Target funds are just fine. I don't like target date funds. I manage my 401k. Went 100 into VIGAX. Still outperforming everyone else at this small company by 2x. You guys are still listening to financial advisors? All you literally have to do is buy VTI VIGAX in 60-40, 70-30, or 80-20. We'll beat 95 of FAs. I was an FA and it was really important that I reviewed my clients' assets in 401ks or outside accounts. It wasn't so that I could convince them to move the money to me. You would be stupid to take money out of a 401k and lose non-vested amounts, but to make sure their entire portfolio was in line with their goals. If their 401k was heavy in assets, I would counterbalance their brokerage accounts with debt according to their risk tolerance and time horizon. We were required to ask these questions to ensure we were acting in the best interest of our clients. Are bogleheads? Yes. No reason to pay anybody to tell you things they find on the internet for free. Invest in low-cost index funds. Mix bond index funds in and balance appropriately as you get older to mitigate short-term risk. I personally do not pay extra for target date funds, which just automatically shift stocks to bonds in the funds as you age. I can do that on my own. What your financial advisor was trying to say is that he felt that your assets were about 1 to 2 high annually and he wanted to help you out by putting some of them into his bank account. When I was in my 20s, everything was just in the available SP 500 fund with the cheapest fees. Now in my mid-30s I have a balanced portfolio with 40 SP, 15 stable return, 15 foreign and the rest divided up evenly between small cap value, mid cap, large cap. I just rebalance it 2 CE per year and Fidelity makes it very easy to do so. Target date or index funds only for me. No active management is gonna beat that in the long term. Dump it all on SP 500 funds to whatever risk balance you are accepting, 90-10, 50-50 etc. Most funds don't outdo the SP 500. I manage my 401k and usually keep it diversified in SP 500 bond index, and occasionally buy in and sell out of my company stock to try to catch swings. Doing so is what has gotten me most of my portfolio growth over the last 3 irregular years. Self-managing is the best way to go. Remember, financial advisors are salespeople looking to get a commission. Target date funds are garbage. Way too many bonds. Self-managing anything has its ups and downs, cost versus risk versus reward. X200B. If your wealth manager is buying high-cost stocks, then yeah, it's probably worth your time. Depends on the individual and how fiscally responsible you are and how much you understand what you are doing. The bar can be pretty low for what is needed. But people can be pretty dumb. Nothing wrong with redundant assets if it means you'll just sell one and put more into the other same asset. Same thing either way unless your goal was not to do that. I self-managed everything from the first day. Need to get educated and do your own research. Yes, for me it is. I self-manage, but I have an associate friend who is a financial advisor who I buy dinner twice a year for to have a sanity check and catch up on things and to make sure I didn't miss anything. As I head into my 4th decade on this planet, I'm considering moving towards a more balanced approach to help sustain my money, but I'm 100. The S&P 500 Fidelity Tracker has the least amount of fees involved and is easily tracked. In the next decade I'll start to look into bonds to protect my nest egg. But most financial advisors will tell you what to do with your money and if you're doing it wrong. But they're advisors, this is what they do. So I have an RIA with Vanguard target funds. Isn't that enough, or do I need to put money into VU or something similar? I understand the TFs are supposed to do all that for you automatically. Can anyone please correct me?